It begins with a geopolitical shock. Mexico announces a strategic realignment, reducing trade with the United States and forging closer economic, technological, and political ties with China. The news spreads quickly across global financial markets, with analysts scrambling to evaluate the consequences. For decades, Mexico has been a critical trading partner, supplying manufactured goods, agricultural products, and energy resources to the U.S., while serving as a gateway for investment and labor mobility. A sudden pivot toward China threatens decades of economic interdependence, triggering a cascade of effects across the U.S. economy, corporate strategy, and stock markets. The immediate impact is felt in trade and supply chains. U.S. importers reliant on Mexican manufacturing face disruptions as supply agreements are restructured in favor of Chinese partnerships. Automotive, electronics, aerospace, and consumer goods industries experience delays, increased costs, and operational uncertainty. Stock prices for companies heavily dependent on Mexican suppliers adjust downward as analysts revise revenue forecasts and risk exposure. Manufacturing sectors in the U.S. feel pressure. Automotive manufacturers, which import critical components from Mexico, face increased lead times and costlier alternatives. Production schedules are disrupted, and inventory management becomes more challenging. Companies must seek alternative suppliers, often at higher cost or with longer delivery timelines. Stock valuations in automotive, industrial machinery, and electronics sectors reflect these increased operational risks and margin pressures. Agriculture experiences immediate disruption. Mexico is a key export market for U.S. corn, soybeans, wheat, and dairy products. A trade boycott redirects Mexican demand toward China or other suppliers, reducing U.S. agricultural export volumes. Commodity prices fluctuate as supply-demand imbalances emerge. Farmers, agribusinesses, and food processing companies face revenue losses, while stock prices for agricultural producers and related sectors experience downward adjustments. Energy markets face uncertainty. Mexico supplies oil, natural gas, and electricity-related resources to the U.S., particularly in the southern states. A realignment toward China alters energy flow and pricing dynamics. U.S. energy companies face volatility in domestic markets and uncertainty in cross-border operations. Stock valuations for oil, gas, and energy infrastructure companies are affected as market projections are recalibrated. Consumer markets are impacted as imported goods from Mexico either disappear from shelves or increase in price due to alternative sourcing. Electronics, furniture, automotive components, and food products see higher costs, which are partially passed on to consumers. Retailers experience both operational and pricing challenges, and stock valuations in consumer discretionary and retail sectors reflect anticipated revenue pressures. Corporate investment behavior shifts. Firms dependent on cross-border trade with Mexico reassess risk exposure, supply chain resilience, and strategic partnerships. Some companies accelerate investment in domestic manufacturing or alternative foreign suppliers. Others face delays or cancellations of expansion projects. Stock markets reflect both risk mitigation strategies and uncertainties about long-term growth. Employment patterns in trade-sensitive sectors shift. Workers in manufacturing, logistics, and agriculture experience heightened job insecurity as companies adjust operations. Layoffs, reduced hours, and hiring freezes are implemented in affected sectors. Workforce retraining programs emerge in response to sectoral realignment, but unemployment in impacted regions rises. Stock market analysts incorporate labor market risk into valuations for major employers and sector-specific ETFs. Financial markets react sharply. Investor uncertainty regarding trade policy, supply chain stability, and revenue projections creates volatility. Companies with high exposure to Mexico experience sharper stock declines, while firms with diversified international operations or robust domestic supply chains fare relatively better. Treasury yields may fluctuate as investors reassess risk in the context of trade shocks and economic uncertainty. Corporate debt markets adjust. Companies facing reduced revenue from disrupted trade face increased borrowing costs. Lenders reassess creditworthiness and tighten terms, particularly for firms with significant exposure to Mexican trade. Stock valuations for banks, bond insurers, and leveraged firms reflect heightened default risk and reduced profitability. Global trade patterns experience recalibration. Mexico's closer alignment with China alters North American supply chains, incentivizing Chinese imports into both Mexico and neighboring regions. U.S. exporters face intensified competition in Latin American markets, while domestic industries seek alternative trade partners. Stock markets for multinational firms adjust to shifting competitive landscapes and geopolitical risk. Agribusiness faces structural challenges. Reduced access to the Mexican market forces U.S. farmers to redirect crops to alternative markets, potentially saturating other regions and depressing prices. Stock prices for agricultural producers, commodity traders, and farm equipment manufacturers adjust to new revenue expectations and market volatility. Automotive sector volatility increases. The U.S. auto industry relies heavily on Mexican assembly plants and component suppliers. Trade disruptions and increased reliance on alternative sourcing create production bottlenecks. Delays in vehicle delivery, cost inflation, and inventory shortages affect revenue. Stock valuations for major automakers and parts suppliers fluctuate sharply in response to trade uncertainty. Energy infrastructure investment slows. Projects dependent on Mexican energy resources or cross-border collaboration face delays. Companies reevaluate capital allocation, scaling back or postponing expansion initiatives. Stock markets reflect cautious investor sentiment in the energy and utility sectors. Consumer confidence declines. Rising prices for goods and uncertainty about supply chains reduce consumer spending. Retailers and service providers experience slower revenue growth, which is reflected in stock valuations. High-cost, import-reliant products face the steepest declines in sales, influencing investor expectations. U.S. transportation and logistics sectors face challenges. Ports, trucking, and rail networks adapt to changing trade flows. Increased reliance on alternative suppliers or routes raises operational costs. Logistics companies experience revenue volatility, and stock prices fluctuate in response to shifting demand and capacity utilization. Technology and electronics sectors experience supply chain shocks. Companies reliant on Mexican manufacturing for semiconductors, components, and assembly must seek alternative suppliers. Costs rise, production slows, and revenue projections are adjusted. Stock markets reflect increased risk in tech hardware and electronics firms. Corporate strategy pivots toward resilience. Firms implement nearshoring, diversification, and vertical integration to reduce dependency on Mexican trade. Investment in automation, domestic production, and alternative international partnerships accelerates. Stock valuations adjust based on anticipated long-term operational efficiency gains and short-term disruptions. Banking sector exposure to trade-related loans is reassessed. Companies with reduced revenues may face higher default risk on working capital and trade financing loans. Banks increase reserves and tighten lending standards. Stock prices for commercial banks, regional banks, and trade finance institutions reflect elevated credit risk. Consumer goods inflation accelerates. Reduced Mexican imports and alternative sourcing increase product costs. Price-sensitive sectors, including food, electronics, and household goods, experience revenue pressure. Stock valuations for retailers and consumer goods companies adjust downward as margins compress. Investment in renewable energy and automotive innovation accelerates for strategic resilience. Companies invest in domestic EV production, battery manufacturing, and clean energy solutions to reduce reliance on Mexican imports. Stock markets reflect positive long-term prospects for innovation-driven sectors. Defense and aerospace sectors face mixed impacts. Supply chain adjustments for aerospace manufacturing and defense components create short-term disruption, but federal initiatives to promote domestic production offer long-term opportunities. Stock valuations reflect a combination of risk and opportunity. Corporate mergers, acquisitions, and joint ventures are influenced by geopolitical realignment. Companies seek strategic partnerships with alternative suppliers or within domestic markets. Stock prices fluctuate based on anticipated synergies, market access, and geopolitical exposure. Regional economies along the U.S.-Mexico border face acute challenges. Manufacturing, logistics, and trade-dependent sectors experience revenue contraction, layoffs, and reduced investment. Stock performance for companies with significant operations in border regions is impacted. Global investors reassess exposure. Emerging market portfolios, multinational firms, and sovereign funds evaluate risk arising from Mexico's pivot toward China. Capital allocation adjusts to account for geopolitical uncertainty. Stock markets reflect changes in foreign investment sentiment and portfolio rebalancing. Corporate earnings projections are revised downward in sectors heavily reliant on Mexico. Analysts adjust revenue forecasts, cost expectations, and profitability assumptions. Stock markets react to earnings revisions and the anticipated duration of trade disruption. Small and medium-sized businesses experience heightened vulnerability. Firms reliant on cross-border supply chains or Mexican market access face cash flow pressures and operational uncertainty. Layoffs, closures, and strategic pivots affect regional economies. Stock markets for small-cap companies and trade-sensitive sectors reflect elevated risk. Consumer technology adoption may accelerate domestically. Companies invest in automation and localized production to mitigate supply chain risks. Stock prices in technology and manufacturing sectors reflect potential efficiency gains and long-term competitiveness. Financial markets experience sustained volatility. Investors navigate uncertainty regarding trade policies, corporate exposure, and global economic implications. Stock indices fluctuate based on both short-term disruption and long-term strategic adaptation of firms. Corporate debt markets are strained. Higher borrowing costs, reduced revenue, and operational uncertainty increase default risk. Investors reassess creditworthiness, influencing bond spreads and stock valuations of lenders and investment firms. Energy prices fluctuate in response to supply uncertainty. Dependence on Mexican energy exports and alternative sourcing creates market volatility. Utility, oil, and gas companies adjust operational plans. Stock markets reflect uncertainty in energy supply and demand. Consumer spending patterns shift. Higher costs for goods, delays in delivery, and uncertainty about economic stability influence purchasing behavior. Stock prices for retailers and consumer-facing firms adjust to reflect anticipated lower sales. Corporate innovation and R&D investment continue in strategic sectors. Firms focus on domestic technology, renewable energy, and automation solutions to maintain competitiveness. Stock markets reflect long-term growth potential in innovation-driven industries. Global trade alliances are reevaluated. Mexico-China collaboration influences Latin American markets, while U.S. exporters seek alternative trade partners. Multinational firms adjust strategy, impacting stock valuations and investor confidence. Agricultural exports are restructured. U.S. farmers pivot to alternative markets, potentially oversupplying other regions and affecting prices. Commodity trading, agribusiness, and food processing sectors face revenue fluctuations. Stock prices reflect the risk of oversupply and reduced profitability. Corporate risk management intensifies. Firms develop contingency plans, diversify suppliers, and hedge against geopolitical and trade risks. Stock valuations reflect proactive measures, but short-term volatility persists. Investment in domestic infrastructure and production accelerates. Companies invest in reshoring initiatives, logistics expansion, and technology integration to mitigate dependency on Mexico. Stock markets reflect optimism for long-term operational efficiency gains. Defense, aerospace, and high-tech sectors adjust to new supply chains. Companies seek domestic sources or alternative international partnerships. Stock prices reflect strategic adaptation and long-term growth potential. Consumer goods inflation persists due to supply constraints and alternative sourcing. Price-sensitive markets face reduced demand, influencing revenue and stock valuations. Retailers adjust pricing and inventory strategies to manage consumer response. Corporate earnings and stock performance remain volatile. Investors react to short-term disruption, long-term adaptation strategies, and policy announcements. Stock indices experience fluctuations as market sentiment balances risk and opportunity. Global investors monitor U.S.-Mexico-China trade dynamics closely. Portfolio adjustments, hedging strategies, and capital allocation decisions influence both domestic and international stock markets. Financial institutions implement measures to mitigate trade-related credit risk. Banks and lenders monitor exposure to companies with significant Mexican dependency. Stock valuations for banks adjust based on credit performance and risk management effectiveness. Economic analysts project slower GDP growth due to trade disruption. Consumer spending, investment, and industrial production are affected. Stock markets reflect reduced economic growth projections and sector-specific risk exposure. Corporate and investor strategies pivot toward resilience. Companies accelerate domestic production, diversify supply chains, and invest in technology-driven efficiency. Stock markets reflect potential long-term gains alongside short-term disruption. Energy, agriculture, manufacturing, and consumer sectors experience ongoing adaptation. Firms adjust sourcing, pricing, and production strategies to navigate geopolitical realignment. Stock prices fluctuate based on sectoral exposure and adaptability. Global trade relations are reshaped over the long term. Mexico's pivot toward China influences trade flows, market access, and competitive dynamics. Stock markets for multinational firms adjust to evolving geopolitical realities. The scenario illustrates how a Mexican boycott of U.S. trade and closer ties with China could cascade across U.S. industries, supply chains, employment, and financial markets. Corporations, investors, and policymakers must adapt to a rapidly changing economic landscape. Stock markets reflect a combination of short-term disruption, sector-specific opportunity, and long-term strategic adjustment. Ultimately, the U.S. economy faces both challenges and opportunities. Firms capable of adapting supply chains, investing in innovation, and mitigating geopolitical risk may gain market share. Consumers, investors, and global partners adjust to a new trade paradigm. Stock markets stabilize gradually, reflecting the realignment of economic relationships, corporate strategy, and global trade flows.